Hey guys, what's up? Felipe here. So as you know, I'm here to keep you up to date with current market news, teachings, and everything tech. So in this video, I'm going to be going into a potential interesting, I don't know if you want to call it investment idea or speculative idea, but supposedly, and this has been ongoing for quite a while, Kroger's, the supermarket franchise, has been in plans for a while now to acquire Albertsons, right? Which Albertsons is Safeway and so forth, and many other supermarket chains in a lot of states in the US. So let's go ahead and jump right into that. So first and foremost, I've been seeing Albertsons, right? Their stock, which is ACI, seems pretty attractive in terms of valuation when you look back into the past. But of course, they are struggling in terms of competing with monsters like Amazon and Costco and Walmart, which are, we all know that it's basically their strategic business plan is the race to the bottom, right? The race to who can have the lowest prices as possible, because we all know shoppers want the lowest prices, right? So why Walmart is so popular and pretty much generates the most or tends to take the most market share wherever Walmart opens, because they have the lowest prices for foods and items and so forth, which is ultimately what customers are looking for. But here we have Albertsons stock, which if you look at it historically is fairly valued. They have a fairly reasonable PE ratio, price to earnings ratio. So just from like looking at the valuation, the stock itself seems attractive, but I'm not really interested in the stock, more as a investment opportunity that I'm looking at that can either be an arbitrage play, because Kroger's is acquiring or is attempting to acquire Albertsons, but there is some red tape around that due to certain litigations and so forth, attempting to prevent the merger from occurring. So looking at Albertsons financials, I mean, they're overall fairly solid in terms of revenue and so forth and so on. They've had pretty much over recent time a consistent, strong revenue. Cost of revenues have increased, and that makes sense considering inflation. Cost of everything has basically gone up. So supermarkets have very small margins, meaning they spend a lot of money to make money, and at the end of the day, they don't walk away with too much of a difference, right? Because the margins are fairly thin in the supermarket business, which is why they seem to be having issues competing with the likes of Amazon and Walmart and so forth. So here, overall, revenues are fairly strong for Albertsons. Cost of revenues up, of course, inflation. See over here, net income has taken quite a bit of a hit, but overall still fairly good considering what the company is doing, right? Or what kind of industry they are, which is the supermarket industry, right? So here, I believe this is in thousands. So if you really want to get deep into the weeds of the stuff, you go through the SEC filings, but I'm not going to do that. So just looking at a synopsis of all this stuff right here. So net normalized income, or my apologies, net interest income, which is irrelevant to supermarkets. This is more for financial institutions, banking, and so forth. So where is net income from net interest income? Where is it? Net income common stockholders. So basically, sometimes it's hard to find net income in these Yahoo Finance financials, but this is pretty good here. So $998 million. of net income. And I would assume this is contributed to common stockholders, which has declined over the last couple of quarters, but still fairly strong. Not bad at all. Seeing their cash flow, so the company has fairly good cash flow, which is basically what they actually walk away with after all business is said and done. So 786 and 400,000 million, 786 million, 786, 400,000. So not bad. It's quite down from quarters in the past, but still not something that seems extremely concerning. But the interest here comes basically from the merger and acquisition of Krogers acquiring Albertsons, right? That's my interest, or that's what grabs my attention here. So to kind of get that information, you can go to sec.gov, EDGAR database, which is just a big, massive database where any publicly traded company has to submit their filings, financial and so forth and so on. So you come here and you find any information really you're looking for. Albertsons ticker symbol is ACI. Just hit here, boom, and we're going to look for their most recent quarterly report. 10Q is annual reports, 10K is annual reports, 10Q is quarterly reports. So here we have annual report, quarterly report, sorry. And all I'm going to do is I'm going to find the merger and acquisition section, right? So you could hit a Command F, Control F if you're on Windows and so forth. And here we have merger agreements. So this is the meat and potatoes of what I'm looking for. So here, if you want to go straight to the source, you want to go into the filings and find this stuff, right? So what is stated here is on October 13, 2022, basically they've been in this back and forth of the merger with preventions from the FTC and so forth through litigation in certain states. So they've been struggling with this acquisition from occurring for a couple of years already. So on October 13, 2022, the company Kroger Co. Parents and Kettle Merger Sub Inc., a wholly owned subsidiary of Parents Merger Sub, enter into an agreement and plan of merger. The merger agreement pursuant to which the merger sub will be merged with and into the company, with the company surviving the merger as the surviving corporation and a directly wholly owned subsidiary of Parents. Pursuant to the merger agreement, each share of a Class A common stock issued and outstanding immediately prior to the effective date of the merger, the effective time shall be converted automatically at the effective time into the right to receive from Parents $34.10 per share without interest. The $34.10 per share consideration is to be paid by the parents, would be reduced by a special cash dividend of $6.85 per share of Class A common stock of Kroger. Special dividend in this case means, hey, they're acquiring, Kroger is acquiring Albertsons for $34.10 a share. However, they're also included in that $34.10 a share. There's a special dividend, which is $6.85 of Kroger Class A common stock. So that's the special dividend, which was declared October 13, 2022, and paid on January 2023. At the effective time, each outstanding equity award denomination in shares of Class A common stock would be converted into a corresponding award with the respect to shares of the parent common stock. The converted awards will remain outstanding and are subject to the same terms and conditions, including vesting and forfeiture terms. And it's a lot going on here. So basically, kind of got the meats and potato there. So the idea is Kroger's wants to acquire Albertsons for $34 a share approximately, which is quite a difference from where it's trading right now. So here we have $34.10 a share minus the $6.85 of special dividend, which is Class A common stock of Kroger's. So that's a pretty decent move we have here. So it's a fairly decent move. Let's say it's 28 bucks from where it currently stands. That's a pretty large move, almost a 50% move, right? In the case that the acquisition actually occurs, because who knows whether it is or whether it's not, because there's a lot of red tape around this, right? So, and I'm gonna go into that right quick. So Kroger vows to terminate Albertsons merger if federal judge delays its closing. And this has been the ongoing issue preventing this acquisition from occurring. So Cincinnati, the Kroger Co. will walk away from the largest acquisition in its history if a federal judge grants a temporary injunction to delay its $24.6 billion purchase of Albertsons Company, Inc. Attorney of the Federal Trade Commission warned a merger would lead to higher prices and lower wages. Attorney for both companies argue more damages will be done by blocking the deal. It could mean layoffs. It could include closing stores. It may include exiting certain markets altogether. Albertson attorney Inu Menigi, which I probably butchered that, said, these are the kinds of things that are on the table if the mergers do not go through. The hearing is tentative, scheduled to begin October 1st. So there's currently ongoing litigation, which should be about to be closing towards the end of October 2024. And that's where the play comes in, right? So, and I'll talk about that a little later. So Kroger's attorney, Matthew Wolf, said financing arrangements and licensing transfer will expire. The deal is delayed, making the deal impossible to close. Monday's hearing was the first time Kroger had publicly stated that it would abandon the merger if an injunction was granted. Both companies have spent a combined $864 million on the deal, and Kroger must pay Albertsons an additional $600 million if the transaction isn't completed. So they already have a ton of money in play here. The FTC said C&S Wholesale Grocers is not equipped to operate the 579 stores the company have offered to sell. The company said C&S will be a viable competitor that preserves union jobs. One of the stipulations of the deal closing, or one of the things Krogers is saying, hey, if FTC, if litigations, if so forth and so on, allow the deal to go through, we're going to sell 579 of Albertsons stores to C&S wholesalers. So that is a divestment, right? So they're divestment or divesting a corporation means that a company is selling one or more of its assets or subsidiaries, right? In this case, Krogers is saying, hey, if the merger is allowed to go through, we're going to sell 579 stores to C&S Wholesale Grocers. So basically, one of the arguments Krogers is saying, and Albertson as well, is they're having issues competing against Walmart, Costco, and Amazon, which makes sense. Walmart, I mean, their prices are just annihilating anyone that wants to enter the supermarket business. You just cannot compete with Walmart anymore. If you're a small business owner and you get into the supermarket world, you're probably not going to survive considering your competitor just about everywhere is Walmart, right? Costco falls into that area as well. And Amazon, which is just basically the everything store. They just want to be in everything, and eventually they are, which is one of Jeff Bezos' plans. He just wants to be the everything store. So these are competitors that Kroger's and Albertsons are struggling with. In some of Albertsons markets, we sell one type of Kraft mac and cheese for $3.49. In the same market, Walmart sells the same Kraft mac and cheese for $2.98. Meinigi said the cost at which Albertsons can buy this mac and cheese is higher than the price at which Walmart can sell it. So race to the bottom, right? Pretty much lower prices to kind of kill the competition out. It's Walmart's business strategy there. Wolf, which is one of the attorneys for where Kroger said that merger would give Kroger a national footprint to match those already in place for its biggest rivals, and those being built by European competitors like Aldi and Lidl, or however you say this name here, which are rapidly expanding in the U.S. Aldi, I've gone to a couple of them in Florida. They're pretty good stores, kind of like a farmer market. But I didn't know they were competing with the likes of Kroger's, Albertsons, and so forth. These folks are taking an enormous share of the grocery market already and are poised to do much more, all at prices much lower than incumbents. Incumbents being the market leaders, such as Walmart, Kroger's, Costco, and so forth. So this is kind of like a business strategy. Most likely Aldi and LIDL, however the hell you say that, are strategically reducing prices to acquire market share. However, they might be losing a lot of money in doing so. So the idea behind a company doing that is they want to acquire as much market share as possible at those lower prices. When they acquire the market share, now they raise prices on you. And if they've kind of annihilated the competitors, they kind of take over the market, right? So that's a business strategy. If Kroger prevents a temporary injunction, it still faces state antitrust lawsuits in Washington and Colorado, and it's likely to face the FTC administrative hearing, which Wolf said would take between 12 to 24 months. Hoping to avoid that fate, Kroger sought an injunction of its own last week in the U.S. District Court for the Southern District of Ohio. It argues that FTC hearing is unconstitutional and an inappropriate attempt to receive multiple opportunities to litigate the same issues. On a further note here, and then I'm just going over information I've come across and found about these issues. So about 2 weeks ago, the Federal Trade Commission sued to block Kroger's company's proposed $24.6 billion merger. So this just goes on a little bit more into that. And then basically the individuals suing are calling Kroger a monopolist of supermarkets because it searches for no comp or low comp stores or stores with little or no competition, basically saying they look for areas where there's not a lot of competition to become a monopoly in those areas. So that's kind of a lot of the reasons behind the litigations and attempting to prevent the merger. Kroger lawyer struck back, pointing out that his company's grocery prices are 10 to 12% lower than Albertsons, which seems like their goal is to acquire Albertsons and kind of bring the prices in par to what Kroger offers. So here we have pretty much wrapping up on this information. Colorado is seeking to block the deal, which would be the largest supermarket merger in the U.S. history. On the grounds it would raise prices for customers. The transaction is facing numerous legal challenges at both the state and federal level from regulators and public officials who argue it will reduce competition in the grocery store industry. For instance, in Albertsons market data, executive testified on Wednesday that sales at his stores take a hit when a Costco opens nearby. Costco doesn't just hurt the bath tissue, it hurts the entire store. So just again, their argument that they're having issues competing with the likes of Costco and Walmart and so forth. The two companies are a familiar neighborhood presence in just about every Floridian. Kroger owns King Supers and City Market and is the largest grocer in the state. Albertsons owns Safeway. The trial is expected to wrap up October of 2024. There is no timeline yet for when the court decision would be reached. The Federal Trade Commission sought a preliminary injunction to block the deal at the district court in Portland, Oregon. The FTC was joined by Attorney General from 9 states. The trial ended last month. The Portland court hasn't issued a ruling yet. Washington State is also suing to stop the deal in its own case. The trial is set to end the day before Colorado's. Krogers and Albertsons agreed to sell 579 stores nationwide to CNS, wholesale grocer, in a divestment, a New Hampshire-based company to address concerns that combined companies will create a monopoly in areas with significant overlap. So that's kind of one of their things they're offering to help the merger occur to the courts, right? So in the court side, according to an analysis done by an AG, done by the AG by an economist who would take the stand later in trial. The state downplayed alternative options because of the economist findings showing that in areas where a new supermarket opens, a nearby Albertsons loses 19% of his business, while a Kroger loses 14%. But when an alternative format store opens, Kroger loses less than 5% of his business, while Albertsons tends to gain business on average. So whenever I hear, courts and so forth bringing in economists to weigh in on the situation, it reminds me of some quotes that I really liked, which is, do not listen to economists, economic forecasters, or to predictors in social sciences. They're mere entertainers. And do not waste your time trying to fight forecasters, stock analysts, economists, and social scientists, except to play pranks on them. So when I hear an economist is brought on to stand for XYZ, I take that kind of stuff with a grain of salt. So on the interesting note of, hey, how can I look at this from certain perspectives and see an opportunity to make some money? There's typically, I like arbitrages, right? An arbitrage is simply, hey, the merger occurs, you make the difference in the acquisition price, right? Currently, Albertsons stock is about 19 bucks, and the acquisition price is 34 and some change. So if an acquisition occurs, you as a shareholder make the difference, right? However, the possibility of this acquisition occurring, considering the facts that I just shared with you, are unknown. I don't know what the court's going to rule. Whether they're going to allow this acquisition to occur or not, I have absolutely no clue. That being said, I gathered some information that states the decisions are supposed to be made by the end of October 2024. So that then leads me to think, hey, how can I potentially look at this as an opportunity to generate some cash, right? Or to play this opportunity. And then that leads me to potentially option straddles, right? Long option straddles in particular. What the heck's a long option straddle? It's just basically an option strategy, right? Here I have this little picture that kind of describes a long straddle, a short straddle, and then a spread, right? But I'm just going to focus on the long straddle because otherwise it's going to be long-winded, right? So what is a long straddle? It's just basically an investor or speculator, whatever you want to call it, buying a long call and a long put on the same underlying. This case would be Albertsons, right? With the same strike and the same expiration date of the contract, right? So let me kind of walk you through what a straddle actually is. So when we're looking at a straddle strategy, right, there are four things we have to be able to do with a straddle, right? One, we have to be able to identify a straddle, long to different types or short to different types of contracts. In this case, I'm looking at a long straddle, which is long to different types of contracts, they call it a put. We have to be able to calculate the break evens, right? Where the contract actually makes money. Only strategy in which we have two break evens. Why? Because we're long a call, we're long a put. Upside break even and downside break even is basically the strike price chosen plus total premium paid for the call side, right? And for the put side is the strike price minus the total premium. And then you have to decide where is it profitable. And then there's an abbreviation that helps called silo. If you're Short straddles, the profit is inside of the break-even range. If you're long straddles, the profit or the money-making opportunities in the outside of the break-evens. So silo, short in, long out. It's abbreviation I use to kind of remind me of this stuff. If we're short the straddle, we want the market price in between the break-evens. If we are long, we want the straddle outside the break-evens. And when we do use it, buying volatility, but the direction is uncertain, or trading range, which is neutral, or stay within the trading range. In this case, the long straddle, you're buying volatility and you want a dramatic price movement in the underlying stock, either up or down, right? So you can potentially put yourself in a position where you make money if the stock price surpasses the call break even, or if the stock price drops below the put break even, right? So a quick example of this is right here, right? Long straddle, hypothetical, right? We're long one ABC October 50 call at 4. That means we paid 4 for that call, and this in options terminology, a 4 would be $400. A long one ABC October 50 put at 2, and long in option terminology, that 2 would be $200. So what is the total premium we just paid in this hypothetical example? 4 plus 2 equals 6. This is a debit because we're paying it out, right? We paid a total of $600 to acquire these 2 different contracts, right? So now we have a call, a 50 call, and then we have a 50 put. So we're going to add the total premium we paid, which is 4 plus 2 equals 6, to the upside, and then we're going to subtract it to the downside. So for the call, we're going to get the 50, which is the strike, plus the total amount of premium we paid, $6, right? Or in option terminology, $600. But to keep it simple, let's say 6 equals 56. So now our upside break even is $56 on the option on the stock price, right? So anywhere above $56, that long call makes money. On the other end, on the put side, let's say here we have the strike of 50 minus the total premium we've paid, which is adding the 2 contracts together is 6. So 50 minus 6 equals 44. So the downside break even in this hypothetical example is $44, right? So if that stock drops under $44, it generates a profit, right? So here I kind of drew or wrote this here to kind of give an example of that. Anywhere above $56, the call makes money. Anywhere below $44, the put makes money. So you're kind of playing volatility in this long straddle example, right? Maximum gain for long straddles are unlimited. Maximum losses is the total premium you paid. In this example or hypothetical example was 6 points, which in option terminology is $600, right? So a quick example here, CMV, current market value, hypothetical example, of course. Say the stock is at $60 by the expiration date of the contracts. It's $400 gain. Let's say the stock is at $30. So I mean that stock declined a lot. It's $1,400 profit, right? So it's a 14 points outside of the break even on the put side, on the long put side. So you look at his points outside of the break even area, and of course, with long straddles, your risk is if there's no movement at all, you lose your total premium. So with this kind of strategy, you definitely want some move to occur, either up or down, because you benefit from a large move to the upside of the stock, of the underlying that option contract is tied to, or a large move to the downside where that option long put is tied to, right? So the play here is volatility. So this is a strategy where you want a big move to the upside or to the downside of of the stock, right? So that's basically an interesting perspective. I'm looking at this, and now to kind of go into that, here we have the option chain for Albertsons. Because let's say hypothetically, merger occurs. That means there's going to be a large move to the upside in Albertsons stock price, right? So a option put in that case would benefit. However, I have no idea. What if the FTC and all the legislators that are trying to prevent the merger from occurring make sure that doesn't occur? Most likely the stock is going to have a dramatic decline, right? So in that case, the long put is going to go up in value. So I was looking at the option chain and I found in particular interesting the January 17, 2025 contracts. It seems like a lot of people, I'm just speculating, of course, are looking at this play as this opportunity because I'm seeing open interest on the call side, a lot of open interest compared to other contracts in the option chain. On the call side, has pretty fairly large amount of open interest. And then on the put side, there's a lot of open interest, which you can kind of see here. So basically the long strata would be long to call, long to put, right? Because if there's a dramatic move on some sort of court decision, the stock's either most likely going to be volatile to the upside or to the downside, one way or the other, right? So that kind of goes into what I was just talking about with the long straddle. So if we look here, which is basically the Albertson January 27, $20 strike, which is just about pretty much near at the money, right? You can kind of see what it looks like. They're both about close to a 0.50 delta. And then one thing you got to be watching out for when you're long call or long options is theta, right? Theta is time decay. If you're short options, you get paid the theta, but if you're long options, theta decays against you. So it has a theta, the call has a negative theta of I think that's $1. So approximately the contract loses $1 a day. And here in the put side is fairly low. So that looks like it loses approximately 89 cents a day, right? So time decay is extremely important in long options, right? Then we got the Vega here in implied volatility. So this is a Vega strategy, right? You want volatility, otherwise you're most likely not going to make any money. You want a big move to the upside or a big move to the downside. But then again, this is just me looking at potential ways to look at this as a potential money generating opportunity, right? What piques my interest is that open interest on both sides of these contracts are fairly high. I don't touch anything that doesn't have over I would say 1,000 contracts. On the call side, we have 19,468 open interest contracts, and on the put side, 22,975. So just interesting stuff, and kind of gives me an idea to give an example of a long option, a long straddle, right? Or I feel like this is a beautiful example of, hey, how can you utilize a long straddle option strategy in its specific use case, right? In this case is a merger acquisition, right? Where the court's involved and possibly they are looking to prevent the acquisition from occurring, but I have no clue. Can the acquisition occur? I have no clue, right? But if it does, stock's most likely going to move dramatically to the upside. And if it doesn't, the stock's most likely going to move dramatically to the downside. In this case, a long straddle potentially makes sense. I don't know. You guys tell me what do you think might make sense in a situation like this? But in case you found this information valuable and like what I share with you, feel free to stay tuned to any sequential videos that I make. I'm always looking for stuff. And if you have any recommendations or something you would like me to check out, feel free to shoot it my way. I would love to do that. And with that being said, thank you guys for joining on. I'll talk to you on the next one.